Hi, I'm Ted Cohan, one of the senior portfolio managers here at Baker Bora Bank, here for our monthly market update. And what we're going to talk about this month is diversification, and why at Baker Bora we always want to make sure to have a well-diversified portfolio for our clients. And kind of to highlight that, what I want to talk about is what's called the Magnificent Seven, which is a name that's been given to 7 of the best performing stocks of 2023. Those stocks are Alphabet, which is the parent company of Google, and then Amazon, Apple, Microsoft, NVIDIA, Tesla, and then Meta, which is the parent company of Facebook. And so those 7 stocks were 7 of the best performing stocks of 2023. Combined, they were up over 100% in 2023 performance-wise. Overall, the market did really well. The S&P 500 was up over 26% in 2023, and the international market was up double digits as well. So it really was a good year across the board. And so sometimes we'll get the question, well, how come you guys don't increase your exposure to an area like that when it's done so well? And we do have good exposure to those 7 stocks in our portfolios. But if you look back just 1 year to 2022, what you'll see is, again, 2022 was a very tough year just across the board, really, index-wise. But the S&P 500 was down about 18%, and those 7 stocks were down close to 50%. So really a much bigger sell-off. And so now on your screen, we should put up a chart here that shows the Magnificent Seven versus the S&P 500 over that 2-year period, so 2022 and 2023. And what you see is that blue line represents those 7 stocks. And what you see is a much bigger sell-off again in 2022, and of course a much bigger return in 2023. The S&P 500 goes down and then comes back, but just not as much volatility. And so again, one of those reasons why we want to have a diversified portfolio is if you have a concentrated portfolio, you're going to have a lot more volatility in your portfolio. You're going to have a lot more up and down, and having diversification still gives you that good long-term return potential that we are looking for, but without as much risk and volatility. And then the next chart that should be coming up here on your screen, it's a little overwhelming, sorry, when you first look at it. But what this shows is on the left-hand side of the chart, it shows several different countries, which represents the stock market index for that country. And then on the top, it has the year over the last 20 years. And then what the chart does is it highlights for what country had the best performance. And so each year it's a little bit different based on whatever country was the best performing stock market for that year. But what I really want to highlight is on that left-hand column on the bottom, it shows the U.S. in blue, and what you'll see is over that 20-year period, there's only 1 year that the U.S. stock market was the best performing index. So again, it's not saying we're not going to have good exposure to the U.S. We always are going to have the most exposure to the U.S., but we want to have good diversification both within the U.S., having growth stocks, value stocks, large, mid, and small cap, but we also want to have good exposure to that international market as well, so that we have exposure to lots of different countries. And the other way to look at that is, over the last 10 plus years, the U.S. market has really outperformed the international market. But if we look at the 10 years before that, it was pretty much a complete opposite, where the international market really outperformed the U.S. So we always have kind of ebbs and flows of that. So we want to be well diversified in all areas so that we can do well no matter what is the best performing area moving forward. So with that, I'll wrap up our monthly market update. As always, if you have any questions, please reach out to your advisor. Happy to answer those directly. And if not, we'll see you next month with the next update. Thank you.